Good afternoon and welcome to the quarterly price index for Q4 2022. And today we'll be looking at how prices have moved for motor and home insurance throughout last year. First, a bit of a background. So at Pearson Ham, our mission is to help our clients improve performance through better pricing. And this is an approach that we take both in our consulting. So we undertake several different types of consulting projects focused on pricing, as well as in our market price tracking and insights that we provide. So accuracy is absolutely crucial to us. And there are a lot of unusual movements observed in general insurance pricing. And a lot of these can be the result of how the prices are collected, whether it be time of day or the day of the week or the number of quotes that have been run or days to inception. So there are several anomalies which we have to identify and strip out. And above all, accuracy of the data is key to us. There's also transparency and clarity of reporting, so making sure that what's being presented is usable and useful to our clients, providing additional insights to go along with that, and consulting, which we can do in addition to that, and developing our skills and our systems and capabilities to make sure that what we're providing is the best it can be. In terms of the services that we provide in market price tracking, we do daily reports looking at the previous day's price movements. We have an online portal which allows interactivity and enables you to conduct scenario modeling and a whole range of services which are available there. We conduct monthly meetings with our clients, sharing market insights and context, and we provide ad hoc support throughout the engagement, as well as any additional consultancy that comes out of that. Before we go into some of the detail of the price movements, I'd like to talk about the methodology. So the data that we'll be using today comes from our consumer panel. So Pearson Ham's consumer panel is made up of real individuals, genuine people with genuine risk details. So we use their actual names and addresses and their actual vehicles and any other details that they provide, which we will be automating the process of entering. We have access to the big four comparison websites in the UK, and we're running quotes through these on a daily basis. The price movements that we share relate to specific individuals, so it's not looking at averages across certain time periods. It's specific individuals, how prices have moved for the same batch of consumers. As I said, we do a lot of data cleansing. There's a rotation that happens. We have to make sure that the panel is refreshed and updated as we move through. And data cleansing takes place to make sure that we are as happy as we can be with the accuracy of the information that's being collected and presented. If you would like more information, then please feel free to contact me directly. You can get me on stephen.kennedy@pearsonham.com. Now let's move on to how prices have changed over the past year. So how did motor insurance prices move? So this is the view that we have. Prices rose each month over the past quarter, moving around 2.3% over the quarter. We were expecting to see increases due to the pressure from claims inflation. But interestingly, the biggest increase was in October, with smaller movements being observed more recently. If we go back a little further, looking over a 6-month period, we can see the larger increases in Q3 have tailed off a bit in Q4. So actually, the kind of the biggest movements, which result in that 6.4% increase over 6 months, were actually in Q3 rather than Q4. The movement has continued to be upwards, but the magnitude of the increases has reduced slightly as we've moved into the last couple of months of the year. So looking at the full year 2022, the most competitive prices quoted on comparison sites increased by around 13.5% over the course of the year. So that's kind of each month is painting a slightly different picture. So very large increases were observed in January in response to the regulatory change relating to general insurance pricing practices, including the ban on dual pricing. As insurers rebalanced renewal versus new business pricing, there was an inevitable rise in new business prices. The months that followed were more interesting. We saw many new products being launched, particularly essentials or economy brands. Reduced levels of cover, increased compulsory excess enabled the most competitive prices to remain relatively low during this time, and it was a period of intense competition. Demand dropped out of the new business market as more attractive renewal prices resulted in more customers renewing with their existing providers, and obviously this put pressure on volume targets. However, rising claims inflation, so we know what's behind this. You've got logistical challenges, supply chain issues, lack of parts, labor shortages. All of these things combining meant that prices couldn't remain low for long, and even for those economy tiers, prices have had to come up. And from the middle of the year, we've seen that premium inflation coming through. If we go back a little bit further, going back pre-COVID, if we can remember that, then things look a bit more interesting and we can provide a bit of context for that. So since March 2020, prices have been dropping right up until the end of 2022. This means that where we are now, so prices at the end of the year for 2022 are still around 1.5% lower than they were at the beginning of 2020. So this would suggest that further premium inflation is still needed, regardless of the kind of the increase that we've seen in claims inflation more recently. Looking at a selection of large established providers over the past 6 months, we can see consistent, relatively large increases, with a few exceptions. For those where we've seen the biggest increases over that 6-month period, we've seen steady increases being applied each month, with a couple dropping off a bit in December. So that will be contributing to the slowdown in the average of the increases that we've seen. There is a bit less consistency when we look a little bit further down the list, with a couple of larger providers bucking the trend, and we can see price reductions being applied over that 6-month period. If we take this back a bit further, looking at these two particular providers from the start of the year, we can see that some of those larger kind of increases were applied earlier in the year in these cases, and that's what enabled and has driven the competitiveness more recently. So what's happening in home insurance? So again, with home, this is combined cover. We've seen some fairly large price increases each month in the last quarter of the year, culminating in a figure of almost 3%. So actually ahead of motor in terms of price increases. However, this follows a bit of a flat Q3 in home. So if we look at the actual kind of movement over the 6 months, it's all driven by the last quarter of the year. So that movement of 3% has actually come more recently. So looking at this over the course of the year 2022, combined home insurance prices have increased by around 9% throughout the year. So as with motor, we can see that big increase at the start of the year following the regulatory change. On home, the increases actually started a bit earlier and tended to be a bit bigger than they were on motor. So we saw increases coming through in November and December in the run-up to the changes being implemented. And again, following that, there was some recalibration. We've seen several new products launched. These have tended to be less on the economy and essentials tiers and more kind of new entrants to the market, but again, with very low prices. So renewal versus new business pricing dynamics, creating opportunities for insurers that don't have big back books to think about. So it'll be interesting to see how that plays out this year. So we've seen a fairly prolonged period of competitive prices remaining relatively low throughout the year. However, the same claims inflationary pressure have driven prices up in home as they have in motor. It's come a bit later, but we can see over the past 3 months, those price increases have flowed through here. Taking a sample of large providers, again, established brands, we can see a fairly consistent picture of price increases over the past 6 months. Steady increases for those insurers where the biggest increases have been observed, and some of those accelerating as we move into December. For others, we've seen some reductions in November, but these picked up again in December. So that was on combined cover. What about contents only? So for contents only, prices increased by around 2.3% in the last quarter of 2022, and the biggest increase being observed in December. So looking back over the past 6 months, we can see that there's been a gradual move in this direction, actually with price reductions being deployed in Q3 and flattening out before turning into the increases that we've seen more recently. And similar movements have been observed as with combined cover and with motor, with a 10% increase in 2022 throughout the year. Actually, most of this we can see coming in January. So we saw the big increases at the start of the year, new entrants coming into the market, keeping competitive rates low. We've seen some recalibration, new product development, causing some disruption around the middle of the year, and then prices starting to creep up, and the biggest increase there being seen in December at the end of the year. Looking at a selection of individual providers, so these are kind of large providers in the contents only market. We can see, ignoring the big swing on the left, movements are consistently upwards, apart from one exception, which we'll look at shortly. And when we look at them trended over the 6-month period, when prices increased in July, so we saw a bit of movement there in the middle of the year. They've remained relatively flat since then for the majority of providers. Other insurers have been playing a bit of catch up, so where they didn't put those increases in earlier, then we've seen those happening, and some of this kind of follows the rises since the end of 2021, actually. So we can see that actually we are seeing some of those pickups in December again, which is contributing again to the average movement that's been observed as a relatively large one in December. So looking ahead, so before I look ahead, I'm going to look back to what did I say what did I think was going to happen in Q4 last time we had the webinar, which was at the end of Q3. So I was thinking that we would probably see somewhere between 1.5% and a 4.5% increase in motor before the end of the year, and it came in at 2.3%, so somewhere in the middle. And the slight slowdown in price rises in the last couple of months is one to watch out for. So we did see the biggest increase there in October, November, December, slightly lower, but still moving upwards. For combined cover on home, I thought prices could go up by around 2%. Actually, the increases were quite a bit ahead of that, so at nearly 3%. So given this, the trend, I would expect that to see that continue into January and into Q1. Similarly, on content only, so I was expecting increases of up to 1.2%, and we've seen kind of way ahead of that at 2.3% in the last quarter of the year. And again, as with combined cover, I'd expect to see kind of those fairly significant increases continuing into January and into Q1 of this year. So what can we expect as we move through 2023 and what's going to come for the rest of the year? So quote demand is something that we've been looking at recently, and we saw a demand drop by about 20% in 2022 following the ban on dual pricing and the positive impact that had on renewal pricing and retention rates. So insurers have been reporting their highest ever retention rates, which takes a large proportion of business out of the new business market. And demand, more recently, we've seen return to previous levels as premium inflation has hit renewal pricing as well as new business. However, conversion remains a challenge. It's lower than it was previously, as the great new business deals are not as easy to find as they once were. So quote demand is something that I would expect to see increasing. We've also got cost of living challenges, which is likely to increase the rate of shopping around. Year-on-year price change. So renewal prices in 2023 are not going to be as favorable as last year. We've come a full 12 months since the changes were implemented. So prices last year and this year will be set on the same basis. And we have seen a significant amount of premium inflation flowing through based on the kind of the claims costs that everybody's experiencing. So I would expect year-on-year price changes, and this is a key driver of shopping around activity to be having an impact there as well. So I think we're going to see some relatively large year-on-year increases, which should and will be less constrained by capping and collaring processes as they would have been previously. And I think this is going to stimulate new business demand even further. Product innovation. So we saw a lot of lower tiered economy or essentials products launched last year, so enabling competitive prices to remain low, and followed by online only products, again looking at keeping prices competitive in a challenging new business market. I would expect to see further product innovation focused again on maintaining competitive offerings for customers. So insurers will be looking at what are the levers that they have available to be able to maintain competitive pricing. Promotional activity. So as well as product development, promotions could play a bigger role in trying to improve conversion figures. So particularly for comparison sites where they haven't had the benefit of back book retention rates, to support them through this difficult time of reduced demand. So anything that can be done to stimulate an improvement in conversion, I think is going to be beneficial to them. So I would expect more innovation in terms of what's available and what incentives there are for customers to convert. And competitive pricing. So although premium inflation is expected, particularly in the first half of the year, the market does remain very competitive. Reduced demand has impacted on volume targets, and where providers have growth strategies, this is important. As prices rise to meet the challenge of claims inflation, we may see the cycle turn again and rates reducing later in the year. I think there's a fine balance that needs to be struck between inflation, competition, demand and growth, and we can expect pricing to continue to be interesting. I think that's the one thing that we can be sure about, is that we're not going to be bored in 2023 with what's happening in general insurance pricing. Okay, so I'm going to move on to a Q&A session. I should have said at the beginning that we were going to have this. For those of you who are regular attendees, then you probably were aware. But if you do have any questions, then please raise them in the chat now, and I'll attempt to answer as many as I can before the end of the session. So I've got one around conversion, so reconversion being a challenge. Do you have any stats to suggest what they were before and after, split between direct and aggregators? It's not. We don't have stats specifically available on conversion figures. A lot of the information that we get is from our clients and from the comparison sites, and is more kind of anecdotal than based on specific data. So our conversations have taken us to that conclusion rather than any analysis. How has the economic climate impacted pricing in Q4 2020? Well, the economic climate in terms of claims inflation, which again is driven by a number of factors which I've already mentioned, that started to creep through. So insurers have tried to keep prices low. They've tried to remain competitive. As I say, demand has dropped out of the new business market, and customers are price sensitive, particularly those ones that are continuing to look around. So insurers have done what they can in terms of the new product, in terms of reducing cover levels, increasing compulsory excess. So the levers that are available to be able to keep prices low, I think have all been used, and it got to the point where prices had to creep up. We are going through the worst cost of living crisis we've seen in the past 40 years, and that is obviously impacting on things during times of kind of hardship and recession. We do see increased claims frequency as well as the costs. The number of claims coming in again will be putting pressure on pricing. So I think there has been an impact, and insurers have done what they can to remain competitive and keep prices low. But I think it's inevitable. Prices have had to come up towards the end of the year, and probably continue to do so into the beginning of this. How do we define top insurers in the chart? So it's selection of insurers who achieve a large number of competitive quotes on the comparison sites. So essentially the top performers in terms of who's gaining the most quotes in positions 1 to 5. what is your estimate for home claims inflation in 2023? So it's a difficult one to do for the full year, but I think, as I mentioned earlier, I would expect to see inflation continuing, so premium inflation continuing into Q1 and into Q2 probably. It depends how long it takes prices to catch up with claims inflation, but I would expect that to continue, maybe up to 10% over 2 quarters. But as I said as well, I think that there does remain intense competition. So towards the end of the year, we may see prices coming down again. So by the end of the year, if we're thinking about a figure of 10%, that probably is going to be lower than that, maybe reduced by half. But again, it's difficult to say at this point. Have you got an estimate of potential motor price rises in 2020? Similarly, I think it's probably going to be kind of a similar picture on motor as on home. So again, we probably see quite a kind of a large increase in the first 3 quarters, which may be kind of reduced significantly towards the end of the year if prices start to down again. It's a difficult one to call right now, but that's kind of what I would expect to be happening. With the expansion of essentials products, do you expect intervention to address this being a tool to separate front book, back book pricing? I think that in some cases, possibly. I think there has been a lot of product development and of a large number of essentials and economy tiers being launched. Some of them quite difficult to see what the kind of the product benefit is. How does it address a different customer need? But I think as long as insurers are able to do that and to be clear about the rationale for the launch of that product and where it meets different customer needs, then there shouldn't be a problem. I mean, it is something which could be seen as a tool just to get around the equivalence question, so where your renewal pricing has to be no higher than the equivalent new business as well. What's the definition of equivalent? But I think so far I haven't heard too much in terms of kind of intervention from the regulators on that one. So I mean, it's difficult to say, but I think as long as insurers are able to demonstrate that it does meet customer needs and it is different and it's necessary, then that's fine. Will you be sharing the presentation slides after the webinar? Yes, we can share that. There will also be a recording, so a video recording of the webinar, which will be sent out. So you can review and share internally. Okay, so we are reaching the end. So I'd just like to thank you for your time and hopefully that was of interest. As I say, if you have any other questions or would like to talk to me about market pricing or anything else, then please feel free to contact me directly. You can get me here, Stephen Kennedy at pearsonham.com, and I'd be very happy to take some time and to have a chat with you. Okay, so thank you very much, and I shall look forward to our next session, which will be at the end of Q1, looking at how prices have moved in the first 3 months of the year.